Hi, welcome back to my channel. If you've been watching the headlines, you probably know something big is brewing in the financial world right now. But what you might not realize is just how fast things are moving behind the scenes. I'm not talking about some distant theoretical risk or a maybe someday scenario. I'm talking about $847 billion. Yeah, you heard that right. Almost $1 trillion just left U.S. banks in the last 14 days. That's not a typo. That's not clickbait. That's the real number. And it's got Wall Street, Main Street, and everyone in between on edge. Now, before you think this is just another doom and gloom video, let me be clear. I'm not here to scare you. I'm here to break down what's actually happening, why it matters, and what you can do to protect yourself and your family. Because if you remember 2008, you know how fast things can unravel when the big money starts running for the exits. And right now, the playbook from that crisis is being dusted off and put back into action. Let's start with the basics. Over the past 2 weeks, U.S. banks have seen an outflow of $847 billion. That's the largest 2-week drop in deposits ever recorded. To put that in perspective, during the worst weeks of the 2008 financial crisis, the outflows were less than half of that. So what's driving this? Why are people and institutions yanking their money out of the banks at record speed? First, let's talk about trust, or more accurately, the lack of it. After years of low interest rates, easy money, and too big to fail bailouts, people are starting to realize that the system isn't as bulletproof as they thought. Inflation is eating away at savings. Bank stocks are getting hammered. And every time you turn on the news, there's another story about a regional bank teetering on the edge or a big institution quietly raising capital just in case. The vibe is off and people can feel it. But it's not just regular folks pulling their cash. The real story is what the big players are doing. Hedge funds, private equity, corporate treasurers, they're not waiting around to see if things get better. They're moving billions out of traditional banks and into money market funds, treasuries, and even overseas accounts. Why? Because they've seen this movie before and they know how it ends. When the smart money starts to run, it's usually for a reason. Now let's get into the mechanics. When you see outflows this massive, it's not just a blip on a chart. It's a signal that the foundation of the banking system is starting to crack. Banks rely on deposits to make loans, fund operations, and keep the lights on. When those deposits vanish, banks have to scramble. They either sell assets, sometimes at a loss, or they go to the Fed for emergency cash. Neither option is good. Selling assets in a falling market just accelerates the pain, and running to the Fed is basically waving a red flag that says, we're in trouble. Sound familiar? It should. This is exactly what happened in 2008. Back then, it started with a few banks getting squeezed, then a couple of high-profile failures, and before you knew it, the whole system was teetering on the edge. The difference now is the speed. Thanks to online banking and instant transfers, money can move at the speed of light. What used to take weeks or months now happens in hours. That's why this $847 billion outflow is so alarming. The system is being stress-tested in real time, and nobody knows where the breaking point is. Let's talk about the ripple effects. When banks lose deposits, they tighten lending. That means it gets harder for businesses to get loans, for families to get mortgages, and for the economy to keep humming along. Credit dries up, spending slows down, and suddenly you've got a recipe for recession. We're already seeing signs of this. Small businesses are complaining about stricter lending standards. Home buyers are getting turned down for mortgages they would have qualified for a year ago. And big companies are issuing warnings about uncertain economic conditions on their earnings calls. But here's where it gets really interesting and honestly a little scary. The Fed is in a bind. On one hand, they want to fight inflation by keeping rates high. On the other hand, high rates make it more attractive for people to pull money out of banks and park it in higher yielding alternatives. It's a catch-22. If the Fed cuts rates to help the banks, inflation could spike again. If they keep rates high, the outflows might accelerate. There's no easy way out. Now, I know some of you are thinking, okay, but what does this mean for me? Great question. First, don't panic. This isn't about running to the bank and pulling out all your cash, but it is about being smart and paying attention. Here's what I'm doing and what I think makes sense for most people right now. Number one, diversify. Don't keep all your eggs in one basket. If you've got a lot of cash sitting in a single bank, consider spreading it out. Use different banks, credit unions, or even look at money market funds for some of your savings. Make sure you're under the FDIC insurance limits, $250,000 per depositor per bank. It's not a guarantee against everything, but it's better than nothing. Number two, stay liquid. In times like these, having access to cash is key. That doesn't mean stuffing it under your mattress, but it does mean making sure you can get to your money if you need it. Avoid locking up all your funds in long-term CDs or investments you can't touch for years. Number three, watch the headlines, but don't get sucked into the hype. There's a lot of noise out there, and not all of it is helpful. Focus on the facts, not the fear. Look for real data, like the deposit outflows we're talking about today, not just scary stories or wild predictions. Number four, think about real assets. In times of uncertainty, things like gold, silver, and even certain types of real estate can act as a hedge against chaos in the banking system. I'm not saying go all in on precious metals, but having a little exposure can help you sleep at night. And finally, number 5, stay connected. The people who get hurt the most in a crisis are usually the ones who are caught off guard. Subscribe to channels like this one, join financial communities, and keep learning. The more you know, the better you can navigate whatever comes next. Let's zoom out for a second. This isn't just a U.S. problem. We're seeing similar trends in Europe, Asia, and pretty much everywhere else. The global financial system is more connected than ever, and when one domino falls, it can set off a chain reaction. That's why the big money is moving now, because they know that once the panic starts, it's already too late to react. So what's the bottom line? The $847 billion that just left U.S. banks is a warning shot. It's the market telling us that trust is breaking down and the old playbook is back in action. The same patterns we saw in 2008, bank runs, credit crunches, emergency bailouts, are starting to reappear. The difference this time is the speed and the scale. If you take nothing else from this video, remember this. The people who come out ahead in times like these aren't the ones who panic. They're the ones who prepare. They pay attention, they diversify, and they don't get caught flat-footed when the music stops. All right, that's it for today. If you found this breakdown helpful, smash that like button, drop a comment below, and let me know how you're feeling about the current banking situation. Are you making any changes? Are you worried? Or do you think it's all just noise? I read every single comment, and I want to hear from you. Don't forget to subscribe and hit the bell so you don't miss the next update. Things are moving fast, and you want to be ahead of the curve, not chasing it. Stay sharp, stay safe, and I'll see you in the next one.